Hey guys, it's Willie from Panda.com. Welcome back to the channel. So today's topic, portfolio margin on Tastyworks versus margin from some other brokers, came from a viewer, First Last. Thank you so much for the idea. So let's go over some basics. So you have three, I guess, different types of brokerage accounts at most places. So you usually have a cash account, a margin account, and at some of the more advanced brokers, like you'll have something called portfolio margin. As far as I know, the ones that I've used so far, TD Ameritrade through their Thinkorswim platform has I think they still have portfolio margin, but it's been a few years, so I'm not sure. Please check on their website, because I know they recently merged with Schwab, so I'm not sure how much longer they'll keep that around. So I'm gonna keep the topic mostly focused on the Tastyworks portfolio margin. So basically, in a cash account, if you want to buy a stock or if you want to sell a cash secured put, you're gonna have to put up the full amount of that stock. So let's say a stock that you want to buy is trading at $100. So on 100 shares, you're gonna have to put up $10,000. And if you were to sell a cash secured put at $100 strike, you'd have to put up the full $10,000. In a regular margin account, most brokers will give you kind of like a 2-to-1 margin. So instead of a putting up $10,000, you would only have to put up $5,000. But if the stock moves around, usually if it goes down, you're gonna have to kind of refill your amount. And that's called a margin call. So if I'm just making up examples. So let's say, for example, the stock goes from 100, let's say, down to 5,000. There's a really bad earnings report, or there was fraud, or something crazy. Your broker's not gonna. Your broker's not your friend. They're gonna say, "Hey, wait a minute. The stock fell down to 5,000. We already lent you 5,000, so you're gonna have to put in enough money to make us whole." So if you both went in 50-50, you're gonna have to put up another 25, at least another 2,500, or depending on what the broker wants to maintain. They usually have something called maintenance margin. So like you have to refill or in other words, add money to your account to make that position whole. So that's kind of like the bad part of borrowing money to trade or invest in general. I think if you're just starting out, I don't recommend it. Even for people that have been trading or investing for a while, I still would strongly recommend that you think about it first. I know, like, we're in a crazy bull market. A lot of people are looking for some fast action and to try to make as much money as they can. But that's usually when bad things happen. So just think about it before you decide to pull the trigger. And then lastly, I want to talk about portfolio margin on Tastyworks. So the way their margin system is a little bit different. So in the previous scenario, usually if you wanted to buy something at, let's say, $100, some brokers will lend you some additional money to buy something. So let's say in the previous example, you wanted to buy a stock, but instead of $100, now it shoots up to $50. But if you have $100 available, your broker will lend you the additional $50, but it's not free. You have to pay some interest on borrowing of that extra $50, and then with your capital, you have $100, and then you have an additional $50. Now you can buy that $150 stock. But what Tastyworks is a little bit different. They have something called buying power and buying power reduction. So let's say, using that same $150 stock example, let's say you only have $75. That might be enough to actually buy that $150 stock. I generally would recommend, if you decide to do that, have a little bit of extra money just in case the stock moves around, because stocks generally aren't going to just like sit around. So they might ask you to in either example, whether you're doing buying power reduction or you're borrowing money from the broker, you have to be prepared to have some extra money in maybe your bank account to refill your brokerage, just in case the stock takes a big hit, and your broker, whether you're using Tastyworks or someone else, they'll ask you, hey, the stock took a hit, or maybe they'll give you a call and phrase it in a nicer way. But basically, the bottom line is you're gonna have to refill your brokerage with some money to kind of, if you want to keep that stock in your portfolio. So basically, the main difference is it's direct and kind of indirect borrowing. So with most brokerage firms, if you want to borrow like an additional amount to buy something, that's usually like their version of margin, and that's how most margining system works in other brokerages. So basically, you have your own money. You start with $100, and then you're borrowing an additional $50 to maybe make some stock purchases. But with Tastyworks, is a little bit different. Let's say you want to buy a $150, but you don't need to necessarily have $150 to buy $150. You just need to have like meet their minimum buying power reduction at, let's say, it's $75 to buy the $150 worth of stock. So it's like their version is a little bit interesting. It's like an indirect way to buy something more expensive. So it's like you're getting like a discount with your broker instead of borrowing money to buy something at a full price. And then for Tastyworks, they're initially to open a margin account, a portfolio margin account, you have to put up $175,000, but they're more realistic. Their maintenance margin is $150, so you have to maintain at least $150,000 in your portfolio margin account to maintain that status. So let's say you started with $175,000 worth of stocks, but unfortunately, sometimes like the stock market's not going to go your way, right? So let's say some of your stocks took a big dump because of bad earnings, or like there's some shady business with the CEO, whatever, right? And then let's say like the value of all your stocks, it goes from 175 down to $140,000. Unfortunately, it was just like a bad day in the market. So now, most likely, this hasn't happened to me yet, but Tastyworks will most likely either send you an email, or they'll give you a call, say, hey, you dipped below $140,000. Excuse me, you dipped below the $150,000 maintenance margin. So now you have to put up an additional $10,000 to bring you from $140,000 to at least $150,000. And because of that, even though I do have a portfolio margin myself, I'm very careful to close out a lot of my short option positions at what they recommend. Well, the tasty trade method is usually if you short options, try to buy it back within let's say 24 days or 21 days before expiration, or buy it at like a 50% profit. So you sold something for like shorted an option for like a buck. Try to buy it back for 50 cents, because buying it back is free. The initial your initial commission is only a buck. So, and then if you buy it back for free, it's only like a round trip is really just 50 cents. All the brokerages such as Schwab and Tastyworks, they'll charge like a 65 cents, like a kind of like these little like a little fee to cover I guess costs or whatever. So still, for most people, if you're trading often, like it's still at Tastyworks, you save a little bit of money, uh, probably at least 15 cents per round trip. But I know some of you, like, they when you employ the Wheel of Fortune strategy, you want to try to save as much money on commissions. So you want to sometimes you go with like these cheaper brokerages, but you still have to take into account any additional fees. I believe even please correct me if I'm wrong, but even with Robinhood and some of the other free brokerages or free like app brokerages, like they still charge you, I believe, exchange fees. So you're still paying something. But I think for if you trade with Tastyworks, at least you have at least in my opinion, a better overall structure. Like I feel like there's, if I'm ever in a bind, like I have someone like watching my back. But with some of the other brokers, like they're sometimes like their platforms like aren't as robust or as fast. But this is just my own experience so far. Knock on wood. I'm hoping Tastyworks maintains like that, like high level of a user experience. And then let's see any other topics that I want to cover on just like portfolio margin in general. So I just like before we jump over to my Tastyworks platform to show you a few examples of how their buying power works. I just want to say again, if you're, before you decide to use any type of leveraged trading or investing, please think about it carefully. Work through a few examples on your own just to see if you're comfortable with it. I really hate to see people lose money, especially like if we're in a bull market. Most people should be making like some type of money, but because of like maybe you're not handling your leverage properly, you're losing money. It's kind of crazy. Like, what are you gonna do if there's like another like really nasty like bear market? You're just gonna like pile like losses on top of losses. That's already bad enough, and then like if you have to owe your brokerage like some type of like let's say you get a margin call and it's crazy. You have to, in addition to like your stock losses, now you have to take money out of additional places to just to make your brokerage whole. And it's just so just be really careful. But let's not end this on a like a sour note. I want to bring you over the Tastyworks example to see how this could work, and how trading on a portfolio margin account could be potentially beneficial to you. So let's hop on over. Hey guys, so we're back on the Tastyworks platform. So I wanted to show you this watch list under their presets. So if you go to Dividend Aristocrats, under the presets, it's their second drop down from the watch list. I mean, there's a lot of watch lists that they have, um, but the Dividend Aristocrat is kind of one of my favorite ones now, because I used to use dripinvesting.org, one of their dividend like champion work list, and there was a lot of overlap, and sometimes I would manually put in stocks into like my own watch list. Like, so for example, you can see like these big forever and spec. Don't get too caught up with like the names. It's just like something that I came for myself. Like the forever ones are like the stocks that I trade most often, and the spec are kind of like more shorter term, like speculative trades, and then the forever more is more like the uh, kind of like more investment style. So, for example, Wheel of Fortune on your Dividend Aristocrats, and then there are some other ones that kind of snuck into this watch list. So I have to kind of maybe prune it a little bit in the future, but that's generally what it is. And then big is just like big expensive stocks that I had my eye on shorting, but like we're in a bull market now, so it doesn't. I mean, I guess you could short if you want to, but I feel like it's doesn't make sense right now. I think it's way too early. But I guess when the time comes, we'll get back to that. So let's go with if you notice, I sorted the dividend aristocrat like the watch list by their IV rank. So this is the measures their implied volatility over the course of the year. So right now they're like in the I guess like the top middle third. I mean it's not that great, but compared to the other dividend aristocrats, is probably the best one right now. Um, I just from looking at the options, I'm not gonna be too happy with this particular trade just because like the option market is like even though it's after hours, it's still kind of wide. It's 81.35. Hopefully, if I decide to put this on for real, um, the markets will tighten up a bit. But let's just go with what we have at the moment. So it's 80 cent bid versus $1.35 ask. It's a it's a 20 delta. So that's not too bad. So let's see what we can potentially sell it for. Most likely in real life, I would put this at between 105. I know the mid price says $1.08 here, but I don't think this particular trade trades in penny increments. I've actually never. I don't think I've traded genuine parts too often. But let's just go with the assumption that you can collect about $1.05. And then what's more important is let's look at the buying power effect because the topic is portfolio margin. Normally, if you wanted to sell this in a cash secured, um, excuse me, if you wanted to sell this 90 cash secured put in a just a normal cash account, you would have to put up $9,000. And then if I think the regular margin would be 4,500, like half. But then look at the savings you get from uh, if you have portfolio margin. I only would have to put up like less than $1,100. So let's just head on over to an Excel spreadsheet just to do some quick calcs. So I'm going to go back to Excel. So let's see what this says here. I'm just going to type in GPC. So 90 put, just to see side by side. Uh, so cash account. Sorry, I can't type. And then regular margin. Oh, I'm so sorry. I guess like next time I do something like this, I'll be more prepared. But since this was a kind of a special request, and I wanted to make sure that I get this out in a timely fashion. Um, so let's just do this. 9,000, 4,500, and then 1,100. I'm just gonna estimate round up to 1,100. Because the thing to keep in mind, even though it says 1,080, this as the stock market moves around and this particular stock moves around, this buying power might not is most likely not going to stay at only 1,080. So like if there's like a lot of volatility in the market, I might have to put up more of my own money into the trade. So this could actually this is what Tasty Trade and Tastyworks call buying power expansion. So instead of only paying $1,100 for the to put on this particular trade, I might have to put up $1,500 or $2,000 because again, like brokerages, even though I like Tastyworks, they're not my friend. Their job is to be a brokerage. They want to service my trades, and in return, they get my commission dollars, and I do believe they also sell do some what they call a payment for order flow. So they sell, they aggregate a bunch of our trades and they sell it off to like big firms. And it sounds kind of nefarious, but it's more common than you think. I think most retail brokerages do this anyway. But in return, we do get a nice platform, and in theory, we get better fills. But this particular example notwithstanding. Um, but anyway, let's just get back to the portfolio margin. So you can see, so that so let's just do this. 9,000 cash account. I know some of the Excel nerds will probably flame me that I could just like copy over the formulas, blah blah blah. So as you can see, I'm only putting up roughly 12% of uh of my own money to put on this particular trade. So in theory, if I wanted to get crazy, uh, divided by, I could do 8 contracts if I wanted to, but I'm not going to. And this is where most traders get into trouble. They think, oh wow, I only have to put up 12%. So if I can do 8 times what this is. By the way, this is just like to get to 800. The reason why I would divide it by 100, or I guess you could divide by one to get um, like the proper number of contracts. Because assuming 100 shares, blah blah blah. But I mean, this is eight. Like you can. I mean, if I was a crazy person, I could do you know, like since I'm putting a person that puts up like the full amount of the trade, I can do 8 times what this person is doing and collect $800. But I'm not gonna do that obviously because that would be a little too crazy. Um, and this is where I'm a little hesitant to share all this. I don't want people to get too crazy and say, "Oh wow, look at what I can do with the same amount of money." And this is where people get into trouble. They over leverage themselves. Um, to me, I know this sounds counterintuitive, but the best time to actually use leverage is when you're in a bear market. So, like for example, earlier in this year, around February or March 2020, when the market was taking a big hit, a lot of people were scared, including myself. I wasn't thinking properly. I was busy trying to like just manage my existing positions, and I really wish I had more cash freed up at the time, because you have a like almost like the best of all types of scenarios. You have high volatility, right? VIX was above 80 at one point, and you had like low stock prices. So that would have been like one of the best times to use a little bit of leverage, because you have like big juicy premiums. So you could sell like your cash secured puts like so far like out of the money, but still collect the you know a, it's still a decent amount of premium. Like for example, now the stock price for genuine parts is 98, but I'm only getting like an $8 discount. And then if I factor in like the this $1.05 commission, I mean $1.05 premium, it brings it down to 97 and or 90, like almost $97, which is not. I'm sorry, I can't think today. $89 cost basis, and which is not bad, but it's not like anything earth shattering. Um, but think about like what would have happened like back in, let's just for curiosity. Wow, I mean, it was almost like half price. Like if you were brave enough, like around like March, you get it around, somewhere in the 60s or the 50s, like you really made out. I mean, that's like almost, let's say you did get it at 50, like it's almost like 100% return in like less than a month. But again, like back then, like when everybody's losing their minds, when people are scared, like we don't think properly, and we don't think about like the money uh, making opportunities. We're thinking of like just like preserving our money at that point. But I did pick up a few bargains here and there. I think I got Disney for like 120. At the time, it didn't feel so good because I was down a bunch of money. But now, like it's almost December and like it's rebounded. So I have a covered call in there somewhere. So I'm gonna wind up making a little bit of money on the overall position. But this shows you the power of options, and then if you use portfolio margin on top of it, and if you're willing to like um, stay calm, one, and two, like have like a good amount of cash like on the side. So like I'm pretty sure in the future there will be like big down days too. Maybe not as big as like what we experienced early in the year, or even back in the 2008 2009 the great financial crisis. But this shows you the power of like uh, investing and trading in like big quality companies. Um, when you have a Wheel of Fortune and the Dividend Aristocrats, like combine that with like good money management skills, like using leverage judiciously and at the right points, you can come out like you can do really well. Even if you mess up a little bit somewhere, you can still come out ahead. Um, and then let's just take this because this is only a cash secure put, so I want to move on to one of my other favorite stocks that I've been trading over the course of the year. Unfortunately, right now, 3M. It's it's almost like the exact opposite. Volatility is so crap. No, not crap, but it's like so low that selling like a cash secured put. To me right now, it's look at how tight it is. Like you're only like two strikes away. Um, I mean, you're still getting a discount. Don't get me wrong, but it's not as good as it once was. So you're probably not even gonna get. Um, oh man, I'm so sorry. Let me flip back to the Tastyworks platform to show you what I'm talking about. Um, whew, glad I caught myself. So like for example, like 3M, you're only getting $99. And it's not as good as a discount as it was early in the year. So if we go back to let's see the 1 year chart, man, I could have picked this up like around 130. I remember selling like 140 and 150 strike, which wasn't bad at all. But like you were able to get like almost $1, and now it's like look at this. It's like if you look at the 150 strike, it's only 21 and 31 cents. It's like, uh. But remember, in you always have to have like strategies in place for different implied volatility scenarios. So like a cash secured put, like to me, wouldn't make sense. A cash secured put is great when you have like high implied volatility and like there's like bad news or bad earnings report. So there's potential for like bigger discounts on the gain. But let me just show you something else. So 3M is one of my favorites because it has a lot of strikes available. So let's just do this. Let's go attempt to do a what I call a dragon diagonal. So if I do this, and again, we're assuming we can get filled in mid price. So let's say out in 2023, uh, if I click on this particular bid, um, something's not right here. Let me just clear this for a second. Okay, that looks better. That makes more sense. So if I get filled on the mid price, I would pay about $19.60. So $1,960. As you can see, the buying power effect isn't as good. Because I think because you're putting up money, and you're not taking any premium, and I think that's why the buying power effect isn't as great, but it's still something. Let's just see what this is. So if I go to, let's flip back to my Excel. So let's do 3M. Uh, the 175 leap. So if let's say in the future, like you can exercise the call, for $17,500, and just let's just say this is 50% again, and then let's go back here. Uh, let's just say it's $1,600. Just want to see what this is. If it's roughly the same. Okay, this actually turns out to be a little bit better in terms of percentage. You're only putting up 10%, but again, this will probably change as like as the as the months go by. Like your 3M might not stay at, most likely will not why not stay at 175. I could see it in 2 years that it could bounce back to, or actually go up to maybe like 200. Um, and then let's just see, for example, how much we can get for, let's see, 30 days. Let's just go to the January 2021. I want to see how much I can get for a covered, it's sort of like a covered call. Uh, yeah, I mean, the premium's not that great, but so let me just show you what I'm looking at here. So for if I wanted to set up a dragon diagonal, I would try to sell each month in the monthly cycles. Try to collect like 74. Excuse me. Because like it's 2 years, so I'm assuming I can collect maybe 24 um, covered call premiums. So let's just see what this looks like. Um, so it's not too bad. It comes out to 1885. If I wanted to put this trade on as a package, so let's just go back to my to the spreadsheet for a minute. let's just say for 1885. I mean, so it's still like 11%. Like I would put up 11 only 11% buying power. Actually, I'm sorry. Oh man, really sorry. It's so now the buying power actually reduced a little bit. Let's just go back. Again, that brings it back to 9%. Let me just show you what I'm talking about. Sorry for all this like flip flopping back and forth. As you can see, the buying power because of the covered call, it brings it down a little bit to 1521. And let's just go back to the spreadsheet one more second because I want to estimate how much. So let's say I only collect covered calls. I just want to see what this comes out to. So let's say 24 times 75 cents. Or actually, I should do $75. So actually, you can actually make some money just on the cover calls alone. Assuming you can collect 75, at least 75 cents or $75 on a full contract, 1800, and you're only putting up uh 15 20 15,021 buying power. Uh, I mean that's pretty good savings. But again, that's like in a perfect scenario. Because the full price of the actual of the call was actually 2165. So you can reduce the cost of that at the money leap call, and let's just see here, $18.85. I mean, it's not bad as you can see. There's a potential cost savings, and that could help your overall return. But you still have to size your position accordingly, because at the end of the day, remember what you're trying to accomplish with a covered call. Well, actually, technically, this is a dragon diagonal, so it's like a covered call, but instead of using that, like paying $17,500, 17,500 outright, you're only paying roughly $2,000, and then if you sell a covered call against it, like it's closer to like you you can reduce your cost to like a very negligible amount, and that's just on the on selling call premiums. That's not even taking into account any capital appreciation. Now, of course, you're not getting the actual dividend when you're selling a. I guess like the correct terminology is like when you're buying a triangle diagonal. So you're buying the leap and you're selling front month premium against it until you reduce your cost basis. But as you can see, I mean, there's a lot of potential like cost savings. And let's just do one last final thing, and then I'll end this video. So let's see. So let's do like a crazy stock, right? So let's do Tesla. The IB rank right now is 2085. So it's like it's not. I mean, I guess you could still sell some, get some decent premium. Um, wow, look at that. I mean, just it's still pretty juicy. So let's say at the 415 strike, you could potentially collect almost $1,000, but you have to be willing to buy Tesla at 415. So on 100 shares, that's 41,500. So let's just go. I'm just gonna pop back into my own spreadsheet and type for a second here. So Tesla, 450, 415 put, 41 500, and then for a margin, it's probably like closer to like 20,750. But again, look at the buying power effect over here. 6,451. 6,000. You know what? Let me just do 6,500 uh, even just to make the calculations a little bit easier. So yeah, so let me just flip over to the spreadsheet real quick. So as you can see, for the stock, if you wanted to buy it outright at at that particular strike, um, it's 41,500, and then on regular margins probably 20,750. But then look at the cost savings again on a portfolio margin account, 6,500. So I'm only putting up, 15. So let's call it like 16% of the actual trade compared to other people. Again, that's a huge savings. So, this is why, some people choose to do portfolio margins, because then let's say instead of just selling one, you can sell two put contracts, and then collect, maybe instead of the original $1,000 on one contract, you can collect almost $2,000 for two contracts. But again, um, I wouldn't necessarily recommend it on like a crazy stock like Tesla, because like what happens like next month, like there's a you know Elon Musk falls down a flight of stairs, and then like Tesla's in a heap of trouble, and then like the stock crashes like past your put strike, and like so like if you try to do like multiple contracts, you're buying, well, like first your buying power um expansion could really hurt you, because then you have to put up more money to into your maintenance margin. But I think overall, I think for most people, if you want to do portfolio margin, I would start off with like like a little bit more rock solid like companies that, like something like a 3M, or like a Visa, where I mean they're obviously they can be volatile too at certain times, but overall, like dividend paying stocks, they generally tend to be a little bit more stable. So if you wanted to juice your returns a little bit, um, instead of doing what your normal contract size is, you can bump it up a little bit, and then that's how you can like leverage your returns a little bit more over time. But again, in my opinion, the best times to do is when you have a big a big down move, because then you get both like the the discount on the original stock, right? And then you also get the potential spike in when you're trying to sell option premium. Then you get like the implied volatility expansion, and that bumps up your premiums if you try to sell. So I think this recording might be a little bit too long already. So if you have any more questions, please let me know in the comment section down below. And then if you can help like if you do like this video, and then consider subscribing to help push out this message out to more people. I think that could help other investors and traders. And hey, thank you again for watching, and thank you first last for this topic. And then, yeah, so I'll see you in the next video. Thanks, guys.